Verisk is in the information services subsector of industrials. It's a software and data analytics technology company that focuses on the insurance industry. We bought it because it's a capital light defensive grower. They have 80% recurring revenues, 90% client retention. They're an industry leader in profitability and operating results. And technically, even though they're acyclical and they benefit from a stable economy, they don't need a roaring economy to do well. It does trade at a premium valuation at a 36 forward, but that's in line with its 5-year average. And as insurers focus on operational efficiency, this company is going to benefit.
Hey, why'd you buy eBay? That stock's been a loser. You know, over 6 months, year to date, it just hasn't really done anything. Over a year, it's down. It's 20% below its 52-week high. Why'd you buy it?
So this is a value company with really low expectations that has a recent focus on cost discipline. And, you know, all you need is that company to come in ahead of its incredibly low expectations. And let's realize that this is still an incredibly profitable business. Typical margins in the retail industry are high single digits. This is a company that has 72% gross margins. It pays a 2.5% dividend, and you know it's attractively valued at 9 times. During the COVID bubble, it went all the way up to 18 times, and so we don't think eBay's going away, and we think this is a good company to own at a time like this. Our clients are going to benefit, we think, from stock selection prospectively.
What's this Ping An Insurance Group, this Chinese insurer that you bought?
So we're well aware that the falling knife risk in China is real. The biggest challenge in deep value investing is timing and position sizing. One of the reasons, and that's really one of the reasons that we're starting with a small position. China is extremely cheap. We've been underweight China, maintain our underweight to China from a macro standpoint, but still like some of the companies. We talked about Baba on the show last week. This is a company that's different. Baba's earnings have been growing. Ping An's in a 2-year downtrend, and it's expected to turn around. And, you know, we think you can buy companies like this at low valuations where their earnings are turning. Remember, this is one of the largest insurers of the world, They offer a wide range of products. They have 600 million people that are their customers, and they have a great brand and reputation in China. It only trades at four times a forward PE, and with revenues starting to accelerate, an 8% dividend yield, buying back more than 10% of their shares annually. This seems to be a pretty interesting way to start to reduce our underweight to China.
You bought more Adobe. Tell me about that one quickly.
Yeah, increasing one of our top 5 positions. We increased it in July on the show. It's up 20% since, with the market up 11. They are on the forefront of monetizing AI. The world might be unsure of how companies are going to make money off of AI, but Adobe is doing it. Firefly's a leader so far, much in the way that Microsoft Copilot has begun to do this. While 32 times is not cheap, it's a big discount to its peers, and you know we continue to like it and are increasing our exposure.
Okay, so you trimmed KLA, you trimmed H&R Block, you trimmed Allison Transmission Holdings, you also trimmed McDonald's. I only want you to talk about McDonald's. Why'd you trim that?
So McDonald's is a case where revenue growth has been driven by price increases instead of volume growth. It makes us think that revenue growth could flatten. Consumer prices across the economy have reset 20 to 30% higher over the last 3 years, and now the growth needs to come from volume. And the key question is, will companies need to cut to continue to grow volume? And so we trimmed all these positions. Mind you, that the other 3 were enormous winners for us. And that's more right-sizing those positions.
I appreciate it, Rob. Thanks for coming on. We'll see you soon. That's Rob Sechan joining us with all those moves. Now, I want to kick them around on the desk, the ones that are relevant to ownership here. You own McDonald's.
I do.
And the stock's been disappointing.
Yeah.
Right? What do you make of this?
Well, yeah, I mean, the stock's only up 13% in the past year, but I actually think that this is a great defensive staple-like company, which I don't have a lot of them in my portfolio. It's not cheap at 25 times, but I think they have a great strategy in terms of digital efforts, which is going to help margins, drive-through and delivery, which will help volume. And they just raised unit growth 4 to 5% at their analyst day last year, last year.
Does it deserve to trade at a premium, and such a premium?
I do, because I think that it's kind of a compounder in a way. Like, it's a low to mid-single digit same-store sales kind of a company. But this digital effort really will help margins, and product innovation is obviously going to help demand, I think, anyway. And in a slower growth rate environment, if we do in fact get that, Scott, that this plays right into the hands of that theme.
Joe, you own Adobe and KLA.
So Adobe, I want to hear a little bit more about what they're going to do with the capital, that the $20 billion that they were going to purchase Figma with. They've walked away from that. Are they going to increase buybacks? Are they going to look for other partnerships? You're not going to get that information until March when they report again, so you might be in a period here where it's susceptible to what the overall tape does. The KLA Corp reported on January 25th. Spectacular earnings. Here's an example. Spectacular earnings. Price action subsequent to that has been disappointing at best.